Hey everyone, this is Kirk here again from Option Alpha, and in this video we are going to walk through stock splits. They're a little bit confusing at some points, but we're going to try to break it down for you guys so you understand exactly what they are and how they have an impact on the shares outstanding and the share price and the company valuation. So board of directors can choose to do a lot of different things with their stock. One of the things that they can choose to do is go through splits and even reverse splits, which we'll cover in another video. In this one, we're going to go through two examples where we go through a 2-for-1 split and a 6-for-1 stock split. And essentially what they are doing is just changing the number of shares outstanding and the value of the individual shares that are out there. One thing you have to understand about stock splits, however, is that the stock split itself has literally no impact on the valuation of the company at the time. In fact, it has no impact whatsoever unless the impact is realized after the split occurs, which we'll talk about here in a little bit. But let's say, for example, that we have a stock that is trading at $54 pre-split. So this stock is $54 per share. So if you want to go out into the open market and buy shares in some company, right now you'd have to pay $54 per share. And let's assume, though, that the company is now worth somewhere around $5,400. So there's a major market cap, but I'm just keeping the math very simple. So there's really only 100 shares outstanding. And so pre-split, you have 100 shares that are each worth $54 a share, which gives you a total value of the enterprise of $5,400. Again, very simple math here so you understand the concept. If the company was to go through a 2-for-1 split, essentially what that means is that every one share that is outstanding now gets split into 2 shares. So this one share right here that is worth $54, and there's 100 of them, now gets split, and now we have twice as many shares that are out there. And so you look at it like this, as this company now has 200 shares that are outstanding, and each of those shares are now worth $27 per share. And so that's how a 2-for-1 split works. Each of the existing shareholders, if you're holding one share of stock in this company for $54, well, now you have twice as many shares for $27. Now you see that the math actually works out exactly the same, that 200 shares at $27 is exactly what the company is worth now. Same thing that it was worth before, $5,400. This actually does not change at all. And that's the really important point. A lot of people perceive a stock split as the company being cheaper, and that's how maybe they want investors to look at the company. Maybe the company's getting too big, that it doesn't allow the average person or a typical investor to buy shares in the company. You look at a company like Berkshire Hathaway, which has really never split in its entire history. So it's multiple thousands of dollars or hundreds of thousands of dollars for the shares. But it's still the same company. It's still valued the same, even if it went through a split. Let's go through another example here where we look at the same 100 shares of stock that are out there and the $54 per share that we have for those stocks. And let's assume now that the company goes through a 6-for-1 stock split. And so in this case, every share is now going to be equivalent to about 6 shares after we increase the number of shares outstanding by a factor of 6. So now we have this company which has not 100 shares outstanding after the split or post-split, but 600 shares outstanding, and each of those shares is now worth $9 per share. Now again, when you look at the math behind this, the company really did not change at all in value. It's just the distribution of how we calculate this. It's now not 100 times $54 per share to get the market capitalization of the company. Now it's 600 shares times $9 per share. And now we have the same company, the same value still at the end of the day. So this is essentially what stock splits are. They're just literally a redistribution of the number of shares that are outstanding. Maybe they want to increase the number of shares that are outstanding. Maybe in a reverse split, they want to decrease the number of shares outstanding. And it changes the per share price. But what is important here is that the actual value of the company for the actual split itself does not change. Clearly, the company can change in value after that when the stock shares start trading. And maybe these lower prices are more attractive to investors, and maybe for a time, it maybe gives the company a little bit of a boost, and more people can see it, and it's now in their wheelhouse, and they can actually trade it. But the end result is that the company doesn't change from a stock split itself. So hopefully this helps out. As always, if you guys have any questions, let us know. And until next time, happy trading.